The content discussed in this podcast is for informational and educational purposes only and should not be construed as financial or mortgage advice. Always consult with a licensed professional before making any decisions regarding mortgages or financial matters.
Welcome to the Canadian Mortgage Show. Here are mortgage professionals Alex Pang and Alex Shanks to cut through the BS and educate Canadians on all things mortgages and real estate.
Let's first talk about it. Obviously, your bank, your mortgage lender, they're never going to offer the best rate up front. They're going to make you do work for it.
Welcome to another episode of the Canadian Mortgage Show. You're listening to episode 56. Alex Pang here alongside Alex Shanks. Alex, how are you doing?
I'm doing pretty good here, Alex. I don't know. It feels like fall and the end of 2025 is just rearing past us. I feel like it's going to be 2026 when I wake up tomorrow.
Yeah, I mean, September has been a crazy month for us, for our family. We just celebrated my wife's birthday yesterday. Happy birthday, Carmen. It ain't over because it's birthday week, so we got something else going on tonight too. So, love my family, but oh my goodness, can't wait for this month to end.
That's our busiest month, like for a family, just all total is like springtime, April and March. My wife's birthday, my mom's birthday, other families' birthdays. It's definitely our busiest time.
Oh yeah, that's the case for us. So it looks like all the September babies. A lot of people got busy during New Year's and Christmas back in the day. But we have a special episode today. We're kind of going to go away from the regular news items that we're going to talk about. We're going to talk about strategies this season, right? Alex,
Yeah,
I'll take it away.
This is a great one. I mean, a lot of people are coming up on those really low interest rates, and they got renewals coming up, and it's just been top of mind. And we thought, hey, why don't we share stuff? Alex and I talk to clients all the time. You may not get to talk to us. Hey, you listen to our podcast, so you can talk to us. But for anyone that doesn't, you already have a broker, a bank. This is just information for you. We're going to go over some strategies, some tips to really help you with everything that's going up. Let's first talk about it. Obviously, your bank, your mortgage lender, they're never going to offer the best rate up front. They're going to make you do work for it. And that's where it's really making sure never sign your offer letter up front. I saw it like 2 months ago. One lender was offering a 6% renewal offer. That was not the rates out there. But hey, some people will just sign that letter that we've seen, Alex, and we want to make sure that that's not going to be one of you.
Let me give you some backstory behind this. Why don't they give you the best offer, Alex?
Because they want people to do work, and they think if people just sign it, obviously they're going to make more money. And I think it's a really bad business model. I think they should treat people that are already at their place better than honestly trying to get new people. But the way that businesses work now, it's always about getting new people in. They got to show that they're increasing the numbers. But in all honesty, it costs a lender more money to deal with someone new than it does on their renewal.
Yeah, I know this kind of practice is not limited to just the finance and banking world or the mortgage world. This happens for telecom as well. Your cell phone rates. I don't know what other industries, but cell phones come to mind.
We just redid our home insurance. It went from $3,500 down to $1,600. I had to take it to somewhere else. I said, hey, can you guys match this? I even asked them, like, tell me why your insurance is better. Oh, like our company, like it's really good. It does that. I'm like, well, everything's the same. My earthquake, my building envelope. You're giving me guys the exact same thing that this other insurer is giving me. So like, tell me why you are better. They just kept saying, oh, our company's good. I'm like, well, I'm not staying with you. $1,600 is a lot of money here.
Yeah, absolutely. Now, and the backstory, the stat behind it we heard is that 75% of people renew their mortgage with their existing lender. Yeah. And because of that, just think of yourselves as banks. Will you give the best deal to your existing customers, knowing that 75% of people are lazy and just want to sign it, forget it, and move on? Are they going to give you the best deal? Probably not, right? So might as well take advantage of that stat and don't give you the best deal because 75% of the people are going to sign it anyway.
Yeah, and let's just talk about the basics for renewal. When you have options, when you get your renewal letter, 9 times out of 10, you do not have to send any other documents. You don't have to send income documents, nothing that way. You just have to have made your mortgage payment on time. Now, where we have seen where lenders will actually say, "Hey, I need to see your income statements again," is on the alternative side of lending. Their risk analysis is a lot different, and they might say, "Hey, for you to renew with us, we now need to see your income documents." 9 times out of 10, as long as you've never missed a mortgage payment, you're going to be able to just sign directly with that lender. Now, that's sometimes the best option. You may not have any other options to go elsewhere, but you want to get a second opinion. So someone can actually confirm for you, "Hey there, Alex, you know what? You need to take this offer because you can't go anywhere else. You're not going to qualify. And so you just got to suck up and take whatever they give you. If you come to me or Alex, we'll always write like an email. We can say, "Hey, Alex, I can offer you a lower rate. We're using it to help you leverage against your lender or your bank. We just do that out of our goodness of our heart. We don't gain anything from it, but we get to help you guys that way."
Yeah, absolutely. No, there could very well be cases where you can't really shop around because maybe your financial status has changed since you qualified for that mortgage, 3 to 5 years ago. Um, Maybe got in, you squeezed right in, you borrowed right to the limit. And at the time, the stress test was 5.25. Well, yes, rates have come down today, but the lowest stress test today is what, 6% now. Now, having said that, the stress test has been removed if you are
We
moving,
get straight
like
transfer. Has to be a
if you're
straight
just doing a
transfer.
transfer, straight transfer, keeping your balance the same, amortization the same. Uh, but in those situations now, like we're seeing a lot of people who are renewing from a 1.5 or 1.9% interest rate to now 4%. Their payments are going to go up. They may not be able to handle it. We've been warning you folks for years and years already, but that day has come. There's a way
Alex,
to
I would
start.
say it's the reckoning for the people that were on fixed rate mortgage at the 1.5. He likes to say, "Hey, now you get the shitty end of the stick." I've had it the entire time on the variable rate.
Yes, yes, yes. Your time has come, right? It's time to pay the piper. But some people may need to, like, might need to re-amortize, might need to stretch it out 30 years. Now, from my understanding, your existing bank won't need to requalify you. It may involve talking with the manager or something like that, and be able to stretch it out to help soften the blow a little bit, with that right now. Knowing that you can't qualify, you can't move over to another lender. Um, you know, Banks may be able to take advantage of you and give you don't give you the best deal, and give you a higher rate. So you got to keep that in mind as well. I mean, if they have the leverage, and you can't really move, I mean, I'd like to think they're not going to like screw you, and all of a sudden give you a 5% renewal offer. But
I
sometimes
think,
if you're backed into a corner, you might have to just take it, I guess, depending on your financial situation.
yeah, and that's where again it's just depending on every single situation. Each person is going to be a little bit different, and that is where you want to know. Now, the big ones is if you have a lower rate and it's coming up, and you started at 25-year amortization, depending on if all you've been doing is paid monthly. Well, hey, your new amortization is going to be 20 years. That's what your new payment's going to be based off, and that is where your payment is going to go up. But hey, you're also paying your mortgage off in 20 years, which is a nice thing, but it's people that maybe took on some extra debt. Maybe they got a new vehicle, they bought a boat. Maybe there was just some life expenses that you actually didn't see happening. And that is where I've seen some people's their payments going up from $1,500 extra to 2,000, depending on their total debt load. And that's where you can talk about options. Well, should we be wrapping up some of this debt into your home? Maybe we have to increase the amortization. Maybe we're taking 50,000 out for equity, and that is going to greatly help people's cash flow. Last night, helped a couple save $2,000. They were paying $1,800 just in interest. They never even sat down and calculated the numbers. Most credit cards are at 20% interest. You're taking that interest, that's all going there. You're not seeing anything that pay down, and just saving $2,000 a month in cash flow, like that's a life-saving thing for people. And I don't think people think about their house that they can do that. Now, you do have to have equity in your home. If you just bought a home last week and you want to try and do this with a minimum down payment, that's not going to work. You do have to have equity inside of your home, but don't just think that there isn't options out there. Don't start looking at like a bankruptcy, a consumer proposal until you've seen all your options. Make sure that you have someone reviewing everything.
Yeah, exactly. Now, in those cases where you're up for renewal and you are looking to refinance. Now, when you do refinance with your existing lender or with somebody else, you will need to requalify. So, um, oftentimes the bank may not give you the best deal because they already have you, so they won't bend over backwards for you. So it's important to consult a mortgage broker, a second opinion, to help you out in that, right? Because I'm seeing a lot more people now who are coming up for renewal who have taken on debt over the last couple of years because of high costs everywhere, and they're looking to consolidate, and we can help continue to bridge that gap and get them to a better place and free up some cash flow there.
Yeah, and that's where it's also coming up with plans. There's a strategy with this of like, hey, yes, we're going to increase your amortization maybe from that 20 years up to 30 years to really help with cash flow. But hey, we're now going to be maybe investing some of that money, or hey, we're going to start using it to pay down the mortgage. Like, there needs to be a strategy in place to make sure like everything is going properly that way. And that's where
Absolutely.
it's not a one-time fix for every person, but right now it could help a lot of people, and that's where we just want to help talk about that. Another one that I see a lot of people not realize, and sometimes this actually works on better, is hey, maybe you bought a property and maybe it was under 1 million when you bought it. It's worth more now. Guess what? You can still go back and get insurable mortgage rates as long as you can prove that the property was actually worth under 1 million when you bought it. You can actually do that, and that's where I find a lot of brokers and banks don't realize this, and that's where sometimes we can actually take it, get you a lower interest rate, like on the insured side of things. And we can even do this for properties that are rentals. Most lenders aren't able to do that. On the insurable side, you can do a transfer over and you're actually able to get that done. Some transfers can even have the amortization extended. Maybe you're at 20 years, but hey, they're actually going to go back and give it to you at 25 years. Again, not every lender can do these things. That's why like there's not a perfect mortgage for every person out there. Every lender has, hey, this lender's really good for that. This lender's really good for that. And that's why you want the options.
Do you want to explain to our followers here what an insurable mortgage is? Because I hear all this saying about insured, insurable, uninsured. What's an
Oh God.
insurable mortgage here?
It's so crazy. I mean, the stuff that we've done to mortgages in Canada just makes it so confusing. And what Alex is saying, we have three different buckets for mortgages in Canada. We have that insured mortgage, meaning you're putting less than 20%. That's where you have to pay the mortgage insurance. There's three mortgage insurers in Canada. So the property has to be okay with them, and you have to pay that. Now, an insurable mortgage is it's still going to have mortgage insurance, but the lender actually pays it on their side. Now, this you have to have more than a 20% down payment. The purchase price has to be under $1 million, and you can only go to a 25-year amortization. Now, to get the lowest of those interest rates, you really need to be putting about 35% down. That's when you're getting in line with an insured mortgage. That's where I don't know if you see it, Alex. I always get people saying, hey, I see 3.69 online. I want that interest rate. Why are you offering me 4%? That is because the 4% is a conventional mortgage. It's uninsurable, meaning you're at a 30-year amortization. Maybe it's a $1.3 million purchase price. You'd rather have the 4% interest rate than the 3.69, because on that 3.69, you have to pay mortgage insurance, where on that other one, you're not. And that's where, again, I think the government, the finance, we make it super complicating for people. Really, it should be insured mortgages and and conventional mortgages. Like that's how it used to be. It was very straightforward. And we've just made it very confusing now.
Yeah, yeah, I totally get it here. What's next on the bucket here?
Well, yeah. So we talked about increasing the amortization to help the cash flow, obviously going from that lower interest rate. So that's one that you definitely want to look at. Now, this is another one that people want to look at, and this is mainly towards people that maybe are business owners and or they're higher income earners. Because for one, the only way that you can write your interest off as an employee is having deductions. Now, either do you have a rental property, you have investments. That's the only way you can write your income down. As a business owner, we get to control our income with expenses and stuff. But one strategy that we are helping a lot with people is, let's pretend, Alex, you had 60,000 in a non-registered investment account. Yeah, you've been saving up, you're putting that 60,000 in there. That's amazing. Now you can't write that interest off. You're making money on it. One strategy we can actually do is your home's coming up for renewal. Well, we can actually refinance. We're going to take out an extra 60,000. You're going to sell your 60,000 that is in your investment account to prepay your mortgage. It's going to drop by 60, but we're going to borrow 60,000 back out. And guess what? We now get to invest that. And now you get to write off those tax deductions because that is now a tax deductible loan. And that is a really good tool for people that are creating their wealth. And also they want to get some tax deduction. And so that is what we call like a debt swap. You can do that for business loans. You can do that for investment loans. It cannot be done in a TFSA, cannot be done in an RSP. It has to be in a non-register account. And so that's where it's finding the right ways. We had done another episode before on cash damming. You own a rental property, you have a primary residence, while it's setting up your mortgage with a re-advanceable home equity line of credit so that you can start getting the tax deduction that way. This is a good one to fully get set up today. When your mortgage is actually up for renewal, is now you can get strategized. Maybe you start cash damming. Maybe you're looking at buying your first investment property. You want to do this now, not a year from now, and then you have to break your mortgage again.
Yeah. We Alex touched on it before. We had an episode on cash damming. This is also a variation of the Smith maneuver. Most of you guys are aware of that. Basically, you know, homes in like principal residence in Canada is not tax deductible. And this strategy is converting your mortgage into a tax deductible investment loan by essentially paying down your mortgage, reborrowing it back through the line of credit, and using it for other vehicles and such.
Yeah, and it just needs to
Okay.
be done in the right way. This is not perfect for every single person. If you want to look at your strategy, you want to look at your taxes, you want someone to work with your financial planner, mortgage broker, financial planner, and accountant. This is something that needs to be done together. For one, when you do these type of investments, they have to be in the right investing. You can't be in what's called a capital appreciation. You can't go buy land and write off that interest. There is no money making from it. It has to be for the goal of making income. You have to be generating income, dividend stocks, rental properties. That's how you're actually going to generate income. And that's how the government, the CRA, lets you write that interest off. If it doesn't have that, they're going to call you and say, hey, you don't get to write off any of that interest.
Yeah. I mean, we always say consult a financial advisor and an accountant before you start any of these, cash damming, debt swap, or Smith maneuver strategies to make sure it fits your goals and it satisfies you. You won't get audited, and it'll be good with the CRA.
Yeah. And then the other one I did want to bring up is we obviously talked about renewing directly with your lender, connecting with a mortgage broker, helping seeing, hey, can we leverage that lender to offer you better? Now, sometimes they'll take the letter and say, yeah, we'll offer you a lower rate. Sometimes they won't. But hey, it's worth the effort to at least see if you can get a little bit lower, if it makes sense to stay at your current lender. Just so everyone knows, the way that mortgage brokers get paid is obviously bringing from lender to lender. We take you from Scotia over to TD, we're going to get paid a commission. Now, that's why you want someone that's really working for you, even if it means, hey, you know what, Alex, I think you should stay at RBC. It's what's best for you. Hey, I'm not going to get paid from it, but it's what's best for you. And that's where you want someone that's working for you, not for themselves.
Absolutely. Yeah. I mean, a lot of times too, like, when you're talking to the bank, you know, you can tell that you're not receiving any help. You feel like they're trying to sell you something. So like the advice that you get, you make sure that whoever's giving you the advice, they're in it for your best interest, not what's in it for them. So this goes to say in any industry, whether you're like in the car industry, real estate, or even finance, like you don't talk to the pre-sale salesperson about, oh, is this a good investment? Of course they're gonna say it's yes. So you gotta talk to someone who's unbiased, third party, who has no skin in the game to get their honest opinion about things.
And that's where now one thing that we see sometimes is you'll see, hey, lenders, we're going to cover the cost of legals. We cover all the costs. Now, in some case, this is true. Some lenders will cover these costs to do a transfer, to do a switch. Other times, what they're actually meaning is we're not covering it, but we'll add up anywhere from 3,000 to 5,000 to your mortgage. And so that will cover the cost. And so that's where, again, it's really breaking down. I've had some clients come like, oh yeah, I'm going to go here because the rate's 3.99. My lender only offered me 4.05. So I'm going to be saving money. And I show them like, you're actually not going to be saving money. It's actually going to cost you money because there's fees that you have to pay with breaking that mortgage now, not a penalty, but to discharge it to get the new one. And like, oh crap, the person never even told me that. And that's just where you want to be open and honest. There is fees for these transactions. And so you want to make sure, hey, what does it look like? Are you actually going to benefit from doing this? And then it's talking about, should you take a fixed rate right now? Should you take a variable rate? Hey, do you take that variable rate to lock into a fixed rate? There's so many different nuances, and there's not a one size fits all for every single person.
Yeah, and speaking of rates, not all rates are created equal. Like, um, like say for instance, let's say a 399 variable for bank A and bank B. It might be the same, right? But bank A, uh, how they compound is monthly versus
Yep.
bank B is semi-annually. And what's the difference? When you compound monthly, it compounds more frequently, meaning it turns out to be the interest rate is actually about 3 to 4 basis points higher than
Yep.
bank B, right? Something that they don't tell you. And bank A could also be like, hey, what are the prepayment privileges? Now we know one of the biggest banks, their prepayment privilege is only 10% a year.
Yep.
Sounds, 10% is like nothing to sneeze at. If you're looking at $1 million mortgage, that's $100,000. Not everyone has $100,000. If they do, great. But other lenders are 15 to 20%. It gives you more flexibility to pay down if you are expecting an inheritance or some sort of windfall that you're expecting to come in, selling a business or selling an investment. You want to pay down your mortgage. You want to have that flexibility. So not all mortgages are created equal. And some lenders can only allow prepayments once per calendar year, right on the calendar year, one time only. Whereas other institutions, anytime throughout the year, the minimum amount is $100 anytime throughout the year.
You can't do $10. It has to be, you have to do a minimum $100 at a time. But that's the flexibility of that. Like, it's pretty awesome. I'm like, hey, I got some extra money. I'm going to add to my mortgage this week. Like, you do want that flexibility.
Yeah, and a few other things to keep in mind is some banks, they dangle money in front of you. They give you a cashback, right, to bring your business over, and it sounds great. Maybe the interest rate's a little bit higher than bank B that doesn't give you the cashback, but the rate's lower. Do the math to make sure it works, because nothing is a free lunch. They may give you $3,000 cashback, but if the rate's higher, it might actually come out at the end that it's more expensive. And at the same time, too, on cashbacks, if you were to break your term, let's say it's a 5-year term and you were to break your term 2 or 3 years into it, there may be a clause that there may be a clawback on the cashback. So if you took a $3,000 or $4,000 cashback to bring your $500,000 mortgage to bank A, but for some circumstance you had to break the mortgage, whatever, sell, refinance, whatever, you might have to pay back part of that cashback that you took from it. So
yeah, and that's
read all the fine print.
The day before, if you break it, and some lenders have a penalty up to the day of, and that's where which I mean, you would think, again, and this is maybe banks, you might want to take this, like, why don't you take all the good things of like other lenders and the bad things that you do, and you could probably make the perfect product for everyone. But at the same time, I think banks don't do that because they really do want some competition, but they just want the competition to be limited. They don't want there to be hundreds of options. They only want there to be like 5 or 10, because some lenders, you can pay it off 30 days before. There's no penalty at all. Some are interest and maturity. Some you have to pay a penalty up to the day of. Some of them, if you forget to sign that renewal letter of maybe, hey, I want to take it, or you want to go into an open term, they automatically renew you into a 6-month fixed rate. And if you can't change that, well, now you're going to have a penalty. You're paying higher rates. And that's just where the lender's never going to reach out to you early. Some of them are getting better at that because they've realized they need to, but they're going to wait until the last minute, because why do they care? If Alex doesn't sign his documents, hey, I'm going to get him at 6.5% interest rate now. I'd rather him do that anyways.
Yeah, exactly. So know what you're going to get into. Most of the times, the people that you speak to at the bank don't really know all this stuff. They may be new. They, there may not be, educated. We know that certain lenders, they've had this huge hiring spree, bring in new mobile mortgage specialist. And the person that you may be dealing with, you'll find that they don't really know what they're talking about. So that's why you need to know who you're dealing with, someone who's educated, who's been around the block, knows the ins and outs of everything and such. So,
Yeah, that's why where I
um,
found like on the mobile, like the mortgage advisor, the mobile specialist, like again, they don't have mortgage brokering licenses. Alex here, we have a fiduciary duty. We do have licenses that way. Now, what I see on like the bank side is people that have been mortgage specialists for 10 years, like 15 years. There is still good ones out there. Like, don't get us wrong there. Like, there is some bank people that are very good at their job, but they've been there for a really long time. It's all the newer ones. They're not getting paid very well. Their training's really poor, and they're out there to push credit cards, investments, and maybe they start at mortgages, but then they go somewhere else next month. They go over here next month. And that's really the problem with the banks is they don't have people specialize in areas anymore. Where back in the day, hey, all you did was mortgages. All you did was investments. Where now it's, hey, we need you to do everything and you're going to suck at all of it.
yeah, absolutely. And yeah, just like Alex said, the person that you're dealing with today at the bank may not be the same person you deal with 3 to 5 years from now. Like, oh, hey, let me talk to Jane. Oh, Jane doesn't work here anymore, or Jane has been promoted. She's no longer in this kind of department. Da da da. You got to deal with somebody new, and when you deal with someone new, they may not know your situation, and your relationship is not there. So be careful who you
What
deal with.
Yeah, well, let's talk one more strategy there, Alex, before we have to go. Now, this is kind of a renewal one. You can use this to get when you do your renewal, but it's also for people that are maybe in the fives and six. If you are in the right lender, you should have access to a home equity line of credit. Now, if your rate is at 6% today, well, guess what? You do have a prepayment privilege on your mortgage. You want to borrow from your home equity line of credit to pay that mortgage down as low as possible. Even the home equity line of credit rate is lower than most mortgage rates that were done 2 years ago. So, hey, you now get to pay that down. Think of it like a ladder. You're effectively dropping your interest rates over and over. Now, what Alex is going to talk about is some of the nuances and some of the strategy that you do have to implement to not cause you any issues.
Yeah. So the reason why we're talking about this laddering strategy is you may have missed the window of breaking your mortgage to go into a lower rate, a fixed or variable, or banks have caught window. We talked about this 6 months ago, where that window essentially shut when banks lowered the posted rates, and what that means is increase the penalties, making the math not make sense anymore. So you may be still stuck out of the cost, of the 5 to 6% rates. Now, mortgages, they have prepayment privileges of 10 to 20%. So in our case, let's use 15 to 20%. So, like Alex said, use the HELOC money if you have a HELOC. Pay down the mortgage, use your prepayment privilege there, and then convert that HELOC part into a termed mortgage, right? Mortgages right now, I would say it's around the low fours, low to mid fours. Could be threes, but let's say it's that range, high threes to low fours. That's a lot less than your 5 to 6% rate. Okay. Now, if you don't have a HELOC, consider getting one with your bank if you have enough equity, right? So, that way you're not breaking it. You can always add it. Of course, there are closing costs, and you need to
Yeah,
reapply and
and
stuff.
that's how you want to be. You want to be with the right lender. If you went to like a monoline lender, maybe a mortgage broker said, "Hey, you should go to MCAP, First National." Some of these lenders don't have access to home equity line of credits. Now, there is banks that can actually go behind them, give you access. So that's where there's always a strategy and a tool that you need to look at, and make sure you speak with someone that's like, "Hey, you know what? Yeah, you could break your mortgage, but hey, guess what? We're just going to get you a second mortgage behind it. It might be a little bit lower, but we can now cover all of your credit cards, your car loan, and hey, you get to keep that lower interest rate right now."
Yeah. So one thing to keep in the mind though, when you do convert that portion of the line of credit into a mortgage, it's essentially a second component of mortgage. You want to try to line up the maturity dates of the HELOC that you're converting to a mortgage with your existing first mortgage. Because if you take something out, let's say a new 3 or 5 year term, well, this new term has a different maturity date than this one, than the bigger one that you're trying to pay down. And so when this comes up for maturity, sure, you can take it elsewhere, but this term portion that has a different maturity date, now you got to pay a prepayment penalty on it. So you want to be able to line it up. So like, it's not going to be perfect, but like, let's say you have 2 years left on your term, you're drawing from your HELOC, paying it down. What you want to term this portion into a mortgage, maybe take a 2-year fixed or whatever it is, so that the closing dates or the maturity dates line up. So if you want to take it elsewhere, you can take it all elsewhere, and the penalty is minimized or even close to zero. Yeah, that way you have options come maturity, not overlapping maturity dates, into infinity kind of thing. So yeah, there's some ideas. I actually spoke to a client yesterday about laddering down. He is pretty close to maturity, so he didn't take me up on the offer, but he was like, hey, that's a great strategy. I'm glad I went with you versus talking to the bank. So this is kind of the value that we have as mortgage brokers. Strategies that the bank is not going to talk to you about. Like, when's the last time, not to poo-poo banks, we love them. We love you guys because we partner with you. When's the last time a bank rep called you to say, here's a strategy to save you money?
Well,
I don't
hey,
know the
here's
last
a
time that ever
strategy.
happened.
You should break your mortgage over here to come over to this lender. The bank's never going to do that. And that can sometimes be why we have clients that work with us, even if our rate is higher today, because we have other ways to save the money. And that's just where you want to know all your options. You want to know all your plans.
Absolutely. All right, Alex, any closing thoughts before we wrap up here?
Well, I think that's a good one. Give some people some options, and just so that they know they got different scenarios out there.
So folks, if you have any questions, because every situation is unique. Your situation may not be the same as Alex's situation or my situation. If you want to talk to us about it so we can assess how we can help you or what strategy moving forward, feel free to send us an email, send us a DM through our social channels. We'll be happy. There was a client that reached out to us. Both Alex and I talked to him, and we were like, hey, if this works out, you can be a case study. We can talk about your situation on the pod. So we're still working through that. We'll see how that goes.
No. Awesome,
So
Alex.
folks,
Well, thank you very much.
all right. On behalf of Alex Shanks, I'm Alex Pang. Thanks for tuning in to episode 56 of the Canadian Mortgage Show. We'll see you next time.
Now, if you enjoyed this episode, make sure to like and subscribe. If you're listening on Spotify or Apple, make sure to follow us. Please give us a 5-star rating. You can even send us an email because we want to know what you guys want to hear about. That's what we're here for. Reach out anytime.